Hey traders, this is Blake Morrow, and you are listening to.
That's what you're listening to after Thanksgiving meals.
All right,
Large meals.
My normal spiel for my weekly week ahead video. Damn it.
Yeah.
It's all right.
Yeah.
Hold on. Here we go. 3, 2. Hey traders, this is Blake Morrow with Traders Summit, and it is the day after the Thanksgiving U.S. holiday. And with me today on Friday, Jim Welsh of Macro Tides. Jim, how are you? Good to see you.
I am well fed, Blake, after a very good and happy Thanksgiving, and hope you claim the same.
Yes, I definitely at least threw on a good 3 to 5 pounds yesterday for sure. So anyway, yes. I hope you had a wonderful holiday. And, I want to say it's a restful holiday, but here we are on Friday and the markets are moving quite aggressively. And I have to say, guys and gals, if you didn't watch Jim's interview last week, Jim talked about the 20-year cycles in the market. This would be a very good time to go watch that particular video, as it seems, Jim, that stocks have really found a near-term top. The markets are a little worried about this South African COVID variant. If you know me, you know my take. I really don't think it's going to be, much of a big deal as far as, shutting down, businesses or really, preventing economic activity, if you will, here in the U.S. But the U.S. is not South Africa, and it's not Europe, and it's not China. So I got to ask you, this COVID, situation that's kind of shook up the markets going into the weekend. I mean, we've seen a sell-off in crude. We're testing the 200-day moving average. We got bond yields that are dumping again. We got the yen that's strengthening. The dollar's ripping against so many emerging market currencies. And you got, the S&P back below 4,600 or, trading at 4,600 actually, just as we speak. So what are your thoughts before we move into like some of the topics you wanted to talk about today? What are your thoughts on the current market environment? Here we are again, very illiquid, day after Thanksgiving, but the market's moving. So give us your.
It is. Well, I think a lot of markets were kind of, there was a fair amount of complacency regarding COVID. At least that was my feeling in the U.S. That was the case. Yeah, that's going to change obviously earlier this week when Austria did another shutdown. Germany kind of denied that they're thinking about it, which meant they probably had been thinking about it, but they decided not to. And so, things were right for this news about South Africa to hit the tape. Technically, and we'll talk about this in a minute, a couple of the markets, the S&P 500 and Treasury yields, were in a position to do exactly what they're doing. So this is one of those times where the technicals were providing what I believe is very important information before the actual event occurs that causes the realization of the technical potentials that were already there. And I think, again, this underscores why the combination of fundamental analysis and technical analysis provides a much bigger holistic approach to the markets and understanding markets than just one discipline or the other. Again, the markets are performing, quite honestly, as I laid out in the last the weekly technical reviews, and as we spoke, last Friday.
Yeah. Okay. Well, I'll tell you what, it was, I think the timeliness of last week's interview was pretty amazing. So again, guys and gals, if you haven't had an opportunity to go read or to go watch that interview, make sure you go watch it after you're done here. So Jim, we've got, you provided a little bit of a chart, and you've talked a little bit about divergences in the past. You were discussing you wanted to discuss in today's video the divergence between like the 10-year yield and the 30-year yield. And just before we hit record, you were talking about, what you had seen in precious metals, because obviously precious metals have been under a little bit of pressure here too. So do you want to give us a little bit of backdrop about what you want to talk about today?
Yeah, it's one of those things, Blake, where there are multiple instruments in a market. So obviously you have the 10 and 30-year Treasury bond, you have the S&P, the Russell 2000, in other words, narrow market cap indices against non-market cap indices. The value line composite would also be, and then obviously gold and silver. And it's important to note when markets are trending that all the components are moving up or down together. And when they don't do that, it often is a signal that at least on a short-term basis, you're at a short-term low or high. And in the case of the 10-year, last March, the 10-year went to a higher high. Like early March, it hit a peak, dipped, and then went to a higher high. The 30-year had a high. The initial high was 250, 2.5%. The subsequent high was 2.45. So you had this.
I was going to ask you, should I show the image that you? Okay, I'm going to do that right now. Go ahead.
So on this graphic, you'll see that the 10-year, there's a red line showing back in March how you had a higher high, and the 30-year made a lower high. Same thing was repeated in October, where the 10-year went to a higher high, the 30-year didn't. And then we did the same exact thing, which was my expectation, as I discussed in the November 22nd weekly technical review, that the 10-year was poised to go above 1.691, but I thought that the 30-year would hold under the peaks we saw in October, which was 215, 217. And that's exactly what happened on Wednesday. And then both the 10-year and 30-year began to decline. And then obviously with the COVID news today, they've fallen quite a bit. So this was a perfect example of how in the last 8-9 months, there's been these intermarket divergences that have really provided important clues. Because as we know, back in March of last year, this year, seems like last year, March of 2021, a lot of people thought the 10-year was on its way to 2%. Instead, it dropped to under 115. So this is, again, where technicals can really help. And as we all know, inflation has been goosing higher and higher. And yet here we are. Both the 10 and 30-year are below where they were in March. So again, it's just a combination of technical with fundamental analysis. Ultimately, I do think, Blake, that in 2022, the 10-year will go above the high of March at 176. And that, I think, could tie in to your lead-in about the 20-year cycle. If that happens, I think that could be one of the reasons why the stock market, sometime, my guess is probably before April, there's a decent-sized correction, 10 to 15%, in part because of higher yields. But we'll cross that bridge, as we get into next year.
So, Jim, I'm going to play devil's advocate here. And I want to ask you, as a trader, I'm a trader. I'm sitting there seeing these divergences. I hear what you're saying, but when you're looking at two divergences like this, or a divergence between two instruments, how do you know which one's going to play catch up, and how do you know which one's the leader and which one's the lagger?
Well, the honest answer is you don't. The first thing you do, though, is make the observation. So in March, when the 10-year went up and made a higher high in yield, and the 30 was almost 5 basis points below, it's kind of like, okay, I'm going to go along the 30-year because that's the one that's showing greater relative strength versus the 10-year. And then you have to obviously put a stop in. Am I going to risk 1%, 2%? So that, to me, that's how it needs to be addressed. No one knows. But if you're not observing these divergences, you're not in the game, especially from a trading standpoint.
Or it's you identify the divergence, and then you wait for an event specific driver, kind of like what happened today. I know it caught a lot of people off guard, not in front of their computers, not paying attention. But you got an event driver that you're like, oh wow, the market's really worried about this X, Y, Z, whatever it is, and then from there you make the move.
Well, the other thing from a technical standpoint is I like to use 5-period versus 13-period moving averages on instruments. So what we're showing here, the red and the green line, this is a daily chart. So it's showing the red and green, the red being 13-period, the green is the 5-period. So you can wait for a crossover where the 5-period crosses below, in this case, and because we're talking yields, for a buy signal. You could also say, okay, I don't want to wait for a daily signal because this setup is pretty good. I'm going to use a 240-minute, 120-minute chart of the same thing to scale in so that you're putting a piece on as you wait for the daily stuff to really fall in line. And then once the daily confirms, you add to that position. That to me is the best way to try to manage risk as you go into a trade like this. Ultimately, I think we're going to see a low in Treasury yields some probably time in the next month. And the other issue is that the debt ceiling has to be increased December 5th or by the mid-month of December. And that's going to unleash a lot of supply. And that's the one thing that has been really beneficial for the Treasury market is the lack of supply. The Treasury can't issue new paper because we're at the debt ceiling. So all they're doing is rolling over existing debt as it comes due. And I think that's why Treasury yields are lower today than they were in March. But the combination of more supply as we get past mid-December and they do the debt ceiling, and the inflation news is going to continue to get worse as we go into 2022, both headline and core. So to me, that could be the impetus for bond yields early next year to really start to ratchet up during the first quarter. And as I said earlier, that could be the trigger for the equity market to experience a decent size correction.
That's really, really great how you've put all that together for us today, Jim. And I'll tell you, I with my colleagues over at Forex Analytics, we talk daily about, what that point is where the markets really start to freak out when yields go higher. And maybe that is the catalyst. I think a lot of people think, oh, well, yields are only going to go up if economic activity is stronger and things are better and all the worries are past us, but maybe there could be other catalysts that drive bonds lower in price and yields higher.
Yep. And again, I think next year is going to be very interesting, Blake, because as we get in early next year, the markets start to price in 3 Fed rate increases potentially next year and so forth. I think there's the potential that they will get too aggressive in terms of anticipating increases, because in the second quarter of next year, the inflation numbers are going to drop significantly just because of the 12-month rate of change stuff that will be taking high values away from April, May, and June of 2021 as we get into next year. So I think there's the potential that the markets will have this correction in the first quarter, and then all of a sudden this stuff is going to kick in and will remove the need for the Fed to be as aggressive as the market's priced in. So the first half of next year could be really, really dynamic in terms of how the markets are going to feed off all these inputs.
All right. Well, Jim, you're always shedding light on the markets, and I love how you look at the divergences, and hopefully that helps traders, inexperienced ones that are learning about the markets, the ones that have been in the markets for over 20 years. I think this knowledge is fantastic for them. And if I'm at home, I got to, first of all, ask you guys and gals to give Jim a thumbs up. That means you like this video, you like what Jim's doing every week. Make sure you subscribe to the channel so you don't miss any of Jim's content. It is free to subscribe to our YouTube channel. But really, if I want to find out more about you, Jim, how do I do that?
macrotides.com, or if you want, shoot me an email, jimwelshmacro@gmail. And if you contact me directly at my email, Blake, I'll send the most recent weekly technical review and or the monthly macro tides. And
one thing I think I need to mention here for those of you that are not subscribed to what Jim does is he updates his subscribers, if during big developments or if things change. And I think that's really good with you reaching out to your subscribers rather than just, here's a weekly review and that's all you get. It's nice that you keep in communication with all of your subs. So kudos to you.
Thank you, Blake. Appreciate it, man. Have a great weekend.
Well, have a great
Friday,
weekend.
Right? Okay.
Have a great weekend, and thanks for joining us as always, Jim.
Hey, thanks, Blake.
All right, we'll talk to you soon.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.